Hello, my name is Michael Keane and I'm a Deputy Director of the Fiscal Affairs Department at the International Monetary Fund. Welcome to Module 1. This module is an introduction to the TADAT framework. The goal is that by the end of this module, you will have a good understanding of what TADAT is, why it's important, what its objectives are, how TADAT assessments are undertaken, and how the indicators are scored. You'll also get a glimpse of how TADAT has evolved. So let's take a look at what TADAT is really about. TADAT is a diagnostic tool that provides an objective, standardized performance assessment of a country's system of tax administration. Now, there are a few elements there that deserve some emphasis. The keywords objective and standardized, and the idea of a country's system of tax administration. TADAT is objective in the sense that it measures the strengths and weaknesses of tax administration against a set of international good practice benchmarks that are widely accepted and that you'll find laid out in the TADAT field guide. So we're trying to minimize the element of personal judgment in the way we score systems of tax administration. And TADAT is standardized because the methodology provides a scoring system that applies in the same way to all tax administrations, irrespective of their geographic, legal, or socioeconomic setting. TADAT assesses the system of tax administration in that it looks not just at the tax administration in isolation, but at all the core revenue functions, even if some of those functions may be undertaken by other agencies. For example, while TADAT does not evaluate the customs administration, it does look at how the entire VAT revenue collection is done, even where customs collects VAT on imports. Let's now look at why TADAT matters. First, by providing an objective and standardized assessment, TADAT allows better identification of the relative strengths and weaknesses in a country's system of tax administration. Second, the understanding of the strengths and weaknesses of a system of tax administration that TADAT provides is critical to understanding what is working well and what could be improved. This approach helps countries focus on improving performance in areas that are weak. Third, government authorities, international organizations, bilateral aid agencies, and capacity development providers have the same understanding about what, in a given country's tax administration, is working well and what's not working well. And fourth, a better understanding of what works, what doesn't work, helps focus on setting reform objectives, establishing priorities, and sequencing implementation activities, therefore reinforcing the design of tax administration reform initiatives. Repeat TADAT assessments can also be used to evaluate the progress of reforms towards targeted objectives and in areas that were identified as weak in the previous assessment. Now, I'd like in this module to discuss how TADAT works. There's a lot of useful information on that in the field guide, and you'll be taking a close look at that in the modules that follow. The guide also shows you how the measures that we use to assess the performance of a tax administration system are set out. You're encouraged to review the April 2019 field guide carefully to understand the main elements of the TADAT methodology. Let's look at the primary outcomes that TADAT is designed to assess. These form the TADAT wagon wheel. The TADAT wagon wheel consists of 9 outcome areas. We call these performance outcome areas, or POAs. These provide the basis on which we measure results and outcomes, by which we mean how we would like to see tax administrations actually performing, rather than the inputs or processes that are used, things like the number of employees, in order to achieve that result. This focus on outcomes, not inputs, is a core part of the TADAT philosophy and methodology. The first performance outcome area, and I'll use the term POA for performance outcome area as we go along, is the integrity of the registered taxpayer base. In other words, we're saying here that all business individuals and other entities that are required to register are actually included in the taxpayer database. The integrity of the registered taxpayer base means that this database is complete, up-to-date, and accurate. The second POA is effective risk management. What this says is that risks to the revenue and the tax administration operations are identified and are managed effectively. Once the risks are known, it's then much easier to mitigate them. The third POA is supporting voluntary compliance. Here, we're trying to assist taxpayers in getting all the necessary information and support to voluntarily comply at a reasonable cost to themselves. If the process of paying taxes is costly, people may not comply easily. The fourth POA is timely filing of declarations. Simply stated, taxpayers should file their declarations on time, as stipulated by the relevant tax law. The fifth POA is timely payment of taxes, meaning that taxpayers pay their taxes in full and on time again as outlined in the tax law. The sixth POA is accurate reporting in tax declarations. What this means is that within the tax system itself, there are effective audit and verification programs that inform the tax administration system when there is inaccurate reporting by taxpayers. These audit and verification methods deter taxpayers from reporting incomplete or inaccurate information in their tax declarations. The seventh POA is effective tax dispute resolution. Here we're talking about impartiality and fairness to the taxpayer, that the dispute resolution process is independent, accessible to taxpayers, and effective. And we're looking too to make sure that taxpayers actually use the system. We're also talking about timeliness in resolving disputes for taxpayers. The resolution finally may be in their favour or it may go against them, but impartiality, fairness, and timeliness are all important. The eighth POA is efficient revenue management. What this means is that the collections are fully accounted for by the tax administration. Collections should be monitored against expectations and analysed to inform government revenue forecasting. And again, as a matter of both fairness to the taxpayer and to secure tax policies of the underlying tax, legitimate tax refunds need to be paid promptly. Finally, the ninth POA, accountability and transparency. Essentially, this requires that the tax administration is transparent in the conduct of its activities and is accountable not only to the government, but as a public institution, also to the citizenry. So now we've looked at the 9 POAs or performance outcome areas of the TADAT wagon wheel. Next, we need to set the stage for the scoring of these POAs through indicators that make up these POAs and, in turn, the dimensions that make up the indicators. In other words, each POA is assessed in terms of a set of what we call indicators, and each of these indicators is assessed by a set of what we call dimensions. A cardinal principle of the TADAT methodology is that scores are given for dimensions, and these scores are combined to arrive at scores for indicators, but there are no single scores for POAs. Additionally, clear evidence must be provided to support these scores. TADAT is evidence-based. So within TADAT, we're looking at these issues like a pyramid, with the POAs at the apex, high-level indicators in the middle, and dimensions forming the base of the pyramid. We're looking at the pyramid in order to score or rate the TADAT performance of the tax administration system. Let's go back to the 9 POAs which you saw in the wagon wheel. Each POA has 1 to 5 indicators, and this gives us a total of 32 high-level indicators. And within these high-level indicators, we have 1 to 5 dimensions, and there are in total 55 of these. These 55 dimensions form the baseline of TADAT scoring. In other words, TADAT scoring starts with the dimensions and builds up to the high-level indicators. Just to recap and emphasize, the POAs themselves are not scored. We score the indicators by aggregating the scores of their dimensions. So each indicator score is based on the score of its dimensions. Some indicator scores are averages of dimension scores. Others are based on the idea of a weakest link. We'll see a little bit more about that later. Now for dimensions, I'd like to go through the TADAT scoring rules, or as sometimes called, the rating rules. Each of TADAT's 55 measurement dimensions is assessed and scored separately on a scale from A to D, according to specific criteria prescribed throughout the field guide. An A score means strong performance, that is, performance that meets or exceeds international good practice. In this regard, for TADAT purposes, a good practice is taken to be a tested and proven approach applied by a majority of leading tax administrations. It should be noted, however, that for a process to be considered good practice, it doesn't have to be at the forefront or cutting edge of technological or other developments. Given the dynamic nature of tax administration, the good practices described throughout the field guide can be expected to evolve as technology and other practices advance, and innovative approaches are tested and gain wide acceptance. A B. Well, a B means sound performance. That is a healthy level of performance, but a rung below international good practice. And then C. C means weak performance relative to international good practice. This means that only the fundamentals are in place. Finally, D. D denotes inadequate performance. Of course, this is applied when the requirements for a C rating or better are not met. Importantly, though, in addition, a D score is given in certain situations where there's insufficient information available to the assessors to determine and score the level of performance. For example, If a tax administration is unable to produce necessary numerical data for purposes of assessing operational performance, for example in relation to filing, payment, refund processing, then a D score is given. The underlying rationale for this is that the inability of the tax administration to provide the required data indicates real deficiencies in its management information systems and performance monitoring practices. So, just to recap, for an A score, the tax administration must demonstrate performance that meets or exceeds international good practice, which means a tested approach that's applied by a majority of leading tax administrations. For a B score, the tax administration shows performance fairly close to internationally accepted good practice in that particular dimension. For a C, the tax administration just meets the minimum performance standards in that particular dimension. In other words, the fundamentals are there, but no more. And for a D rating, we have inadequate performance. In this instance, the minimums for a C or better are not met. The score may also be a D if the assessment team considers that supporting information, the evidence required that should be available, is either insufficient or simply not available. So, now going up the pyramid, how do we build the scores of the indicators from the dimension scores? The scores of the dimensions of a particular indicator are used to determine the overall score for a specific indicator. For example, if a particular indicator has 4 dimensions, which have been assessed A, B, C, and D, the overall score of that indicator will be based on those 4 scores. Now we figure an indicator score using one of 2 methods, M1, method 1, or M2, method 2. These approaches are analogous to the methods used by the Public Expenditure and Financial Accountability Framework, or PIFA, that you may have come across. Let's go over how you combine scores across dimensions to arrive at just one score for the indicator they make up. Well, for indicators that have only one dimension, there's no real issue. The score for the dimension becomes the score for the indicator. For indicators that have more than one dimension, we need some way to combine the several scores for the dimensions into a single score for the indicator. And this is where TADAT uses the 2 different methods I just mentioned. M1, or method 1, looks at the weakest link in the connected dimensions. In other words, poor performance in one dimension of the indicator is likely to undermine the effect of good performance on other dimensions of the same indicator. This may be clearer with an example. Imagine a beautiful house. It has doors. I think I see 4 doors. And if all the doors are secure, properly secured, there's no weak link in the security of the house. But if 3 of the 4 doors are secure, but the other one is not secure, we have a weak link. That house is not secure. However well you secure the other doors, that unsecured door is a weak link. In this spirit, using M1, the score of the indicator is based on the score of the dimension with the lowest score. Under the other approach, M2, method 2, the indicator score is simply the average of all the dimensional scores of that indicator. Using M2, a low score on one dimension of the indicator does not entirely negate the effect of higher scores on other dimensions of the same indicator. That all sounds like a mouthful, but M2 is simply about averaging. For example, on a soccer or basketball team, not all the players will be at the same level of skill during any particular match. But at the end of the day, a poor performance by one is likely to be averaged out if there's much better performance by another. That's how M2 works. And in the field guide, we have rules for converting dimensional scores, given in base of letters, to an indicator score using M2. You can see that in Table 2 of the field guide. Well, congratulations. So far, you've done a great job. I hope you've enjoyed our journey through Module 1. It was a real pleasure talking to you about the fundamentals of TADAT. You're now all set to move on to Module 2, which is preparing for a TADAT assessment. Good luck.